Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week, and all of the links are in the show notes below. Topic number 1 from RNZ on the 24th of July, rents fall for the first time since 2009. Topic number 2 from Good Returns on the 23rd of July, record number of deals being done by first home buyers. Topic number 3 from Elite Agent on the 23rd of July, New Zealand buyers and sellers finally find common ground on price. Fourth topic from Good Returns on the 22nd of July, green light burning brightly for August interest rate cut. And topic number 5, topping up $300 a week. How much do property investors actually make? So first up for this week in review from RNZ on the 24th of July, rents fall for the first time since 2009. For the first time in over a decade, national rents in New Zealand have declined on an annual basis, according to property research firm Cotality. Citing updated data from the Ministry of Business, Innovation and Employment, otherwise known as MB, Cotality reported that median rents in the 3 months to May fell by 0.3% compared to the same period last year. The drop follows earlier signs of reduced asking prices for rental listings. Cotality's chief economist, Kelvin Davidson, noted that this shift is significant, given the substantial rent hikes seen between 2021 and 2023. He pointed out that annual rental declines are rare, last occurring during the global financial crisis and before that, the Asian financial crisis. The decline hasn't been uniform across the country. Auckland and Wellington saw the biggest drops, with Auckland's rents falling by nearly 2% year on year. In contrast, Dunedin recorded strong growth of nearly 10%, while Hamilton rents rose by about 4%. Davidson explained that although renting remains challenging, the pace of rental growth has slowed. He attributed this to already high rent levels, easing migration pressures, and an increase in available listings. He also mentioned that a greater number of smaller rental properties may have contributed to the overall decline, though not entirely. Looking ahead, Davidson suggested that rents are more likely to plateau than continue falling. Typically, he said, the rental market adjusts through long periods of flat growth, during which affordability improves as incomes rise. In tough economic times, we often see demand shifts in rental properties, especially with 1 to 2 bedroom properties, as families and friends move in together to help reduce the cost of living. Combined with below average net migration, it's no surprise that rents have softened somewhat. Although this could pose difficulties for landlords seeking to raise rents, it's important to understand that it's not a permanent trend, and it is likely to improve when the economy shows stronger signs of growth and unemployment levels reduce. In the meantime, it's great news for tenants. Nationally, house prices rose 0.2% in June, but fell 0.1% over 3 months, with 85,951 properties sold last year. Average gross rental yield is currently 3.8%, which is the highest it's been since mid-2016. We are certainly seeing much higher yields than those being negotiated or created in the current market. So it's a really good time to be buying a property investment or a home, as you'll see in the next topic. But summary is this first topic. So rents are on the downturn for some areas, which is great news for tenants. And nationally, house prices are starting to show small signs of growth as well, which means it's a pretty good time to be buying. Second topic from Good Returns on the 23rd of July, record number of deals being done by first home buyers. First home buyers continue to play a major role in New Zealand's property market, making up just over 26% of all property purchases in the second quarter of this year, according to Cotality's latest buyer classification data. This resilience comes despite mortgage payments often exceeding rent costs. However, over the long term, this is my feedback here, over the long term, mortgage balances reduce, whereas rents tend to increase. So it's great to see so many first home buyers taking advantage of the current market conditions. Many first home buyers are leveraging KiwiSaver funds for their deposit, and taking advantage of low deposit lending allowances permitted under the current LVR or loan to value ratio rules, meaning that a lot of first home buyers are borrowing 90% of the purchase price to get their foot onto the property ladder. Regionally, the share of first home buyers is highest in Wellington, followed by Hamilton, Auckland, and both Christchurch and Dunedin. As overall market activity increases, the number of first home buyer transactions is also rising. Several factors are supporting this trend, including the fact that property values remain about 16% below their peak, which helps make home ownership more accessible for some people. The ongoing aspiration to get on the property ladder also remains a strong driver. At the same time, mortgaged multiple property owners, typically investors, are re-entering the market. They accounted for about 23% of the purchases in Q2, which is an increase from 21% last year, although still below the long-term average of 25%. Activity among smaller scale investors, that's those owning up to 4 properties, is helping fuel this rebound. Their share of the market has grown from 12% to 14%. Investors are increasingly targeting the lower end of the market, with 24% of mortgaged multiple property owner purchases now in the bottom 30% of property values. That's an increase from 21% last year. There's also a shift back towards buying existing homes rather than new builds. This year, mortgaged investors have accounted for 23% of existing home purchases. That's up from 20% in 2023. Vitality Chief Economist Kelvin Davidson said this shift is expected given that existing homes are no longer disadvantaged by the previous rules on interest deductibility. But in my opinion, this is also potentially due to the number of investors that got burned by buying new builds at the peak of the market with negative cash flow when interest rates were really low. Many of those investors really struggled when interest rates increased off the lows of 2.5% to 3% interest rates, and they continue to struggle with negative cash flow, even now that interest rates are below average again. Not to mention the negative equity or loss of equity if they were forced to sell due to unaffordability issues. Davidson noted that the abundance of listings may also be creating opportunities for investors to buy at lower prices and potentially secure higher rental yields. This is certainly something that we're seeing in the current market. He added that lower mortgage rates are reducing the cash flow shortfalls that many investors have to cover out of pocket. A typical weekly top-up may have dropped from $400 to $500 to around $200 over the past year. This does not mean that you can't find positive cash flow properties in the current market, because you absolutely can. You're just not likely to find that in new builds. Davidson cautioned that conditions aren't entirely favourable. Rents have flattened, as mentioned previously, or even declined in some of the key markets like Auckland and Wellington, while other costs, such as council rates, continue to climb. However, as already mentioned, because values have also dropped, rental returns have actually improved. In addition, Davidson said that new debt-to-income lending restrictions could be starting to affect some investors' borrowing capacity. Our experience is that this is really only impacting on property investors with multiple mortgaged investment properties, not new investors. New investors are still much more likely to be limited by either their available equity or deposit or their incomes for loan serviceability rather than the debt-to-income restrictions. Topic number 3 from Elite Agent on the 23rd of July, New Zealand buyers and sellers finally find common ground on price. A new report from realestate.co.nz highlights a surprising shift in New Zealand's property market. Sellers are now, on average, achieving sale prices above their final asking price. This suggests that buyer and seller expectations are beginning to align more closely, potentially also that we're starting to see a few more of those multi-offer scenarios coming back into play as well. The analysis, which is based on over 53,000 residential properties listed and sold between January last year and May this year, found that while the average asking price sat at $894,915, the average sale price reached $898,845. netting vendors an additional $3,930. So, not a huge difference. Let's face it. The comparison used monthly sales data from the Real Estate Institute of New Zealand, matching sale and asking prices in the same month that the properties were sold. According to realestate.co.nz spokesperson Vanessa Williams, this signals a turning point for sellers after a challenging 18 months. She noted that vendors appear to be setting more realistic price expectations, which is leading to better than expected sale outcomes. Out of the 19 regions studied, 8 saw average sale prices exceed asking prices, while 11 still showed shortfalls. Wellington topped the list, with sellers receiving an average of $17,185 more than their asking price. Properties there had an average asking price of $901,484 and sold for $918,668. Canterbury and Gisborne also saw notable gains. Canterbury sellers earned $13,721 above asking on average, with an average sale price of $759,715. In Gisborne, the average home sold for $704,256, which is $11,835 more than the average asking price. Not all regions experienced this upside, however. Coromandel recorded the largest gap in the opposite direction, with sellers asking just over $1.116 million, but accepting an average of $45,673 less than their asking price. Northland and Waikato also posted notable shortfalls of $14,117 and $8,399 respectively. Williams emphasised that successful property deals depend on flexibility and realistic pricing from both buyers and sellers. With steady prices and increased listings, she said fair negotiation is often the key to closing a deal. My opinion is that it's always the win-win negotiations that tend to be the best ones, but remember there's a lot more to negotiate than just the purchase price to get a good deal. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor, and all of our free events are held online live. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Topic number 4 from Good Returns on the 22nd of July, green light burning brightly for the August interest rate cut. A cut to the official cash rate, the OCR, next month now appears highly likely, according to the Bank of New Zealand. Despite annual inflation sitting at 2.7%, BNZ research head Stephen Topless says that fears of holds on rates were largely dispelled by the softer than expected 0.5% rise in the CPI, the Consumer Price Index, for the June quarter. In other words, although inflation increased, it didn't increase as much as expected, and it's still within the 1 to 3% range that the Reserve Bank targets. Now, the Reserve Bank of New Zealand has acknowledged inflationary risks in its July monetary policy review, but considers them temporary, effectively paving the way for a rate cut in August. A key driver of the subdued inflation figures is the ongoing weakness in the residential property sector. The cost of home ownership, which includes building expenses, dropped 0.1% over the quarter and rose only 0.8% over the past year, its lowest annual increase since the global financial crisis and the 98-99 recession. This slowdown has also impacted property maintenance costs, which rose just 1.4% annually. Topless pointed out that price declines are evident in household items such as furniture, textiles and appliances. Insurance costs have also eased, with annual inflation falling from 14% to 6%, so still quite high, and just a 0.7% quarterly rise, suggesting that further declines are likely, which would be great. No. However, not all areas of the CPI are easing. Topless emphasised that rising living costs are placing significant pressure on household budgets, which in turn poses a major challenge for any meaningful economic growth. With real disposable incomes under strain, consumer spending is unlikely to lift significantly, he said. Topic number 5 for this week in review from RNZ on the 22nd of July, topping up $300 a week. How much do property investors actually make? According to recent data, a significant number of New Zealand property investors are not making money from their investments, and even those who are earning profits are making relatively modest returns. Figures released under the Official Information Act show that in the 2024 tax year, the average rental income for profit-making investors was just $15,680, and that's equivalent to a 1.7% return based on average house prices. Individual investors earned an average of $13,240, while trusts reported $26,490. These numbers have remained relatively flat in recent years, with returns of $15,590 in 2023, $16,680 in 2022, and $14,800 in 2021. RNZ previously reported that over 50,000 of New Zealand's approximately 120,000 property investors had been operating at a loss. That's nearly half of the investors in this country. Nearly half of this country's investors that are potentially doing it all wrong, in my opinion. Simplicity chief economist Shamabeel Yaqub said that the low income returns show investors are not in the market for cash yield. Instead, they're driven by capital gains, banking leverage, and tax advantages not available to other asset classes, which is a sweeping generalization there, if I can say so. My opinion on this is that it's more likely a reflection of the fact that not all properties make good investments, and most new investors don't understand the fundamentals of smart property investing. They buy with emotion instead of buying based on the numbers. They take what they think is the easy option, only to discover when it's too late that they've created themselves a house of cards. Yaqub added that a 1.7% rental return and a typical equity cost of about 10%, investors are essentially betting on house prices rising over 8% annually, which is higher than the long-term average. Yaqub noted that when including capital gains, investors earned an average rental return of 6.6% over the past 5 years, which is interesting considering the significant downturn after the peak of the market. In 2021 and 2022, returns hit 15% and 19% respectively. However, losses followed, with average capital declines of nearly $85,000 in 2023 and $21,362 in 2024. Matt Ball of the New Zealand Property Investors Federation said that these outcomes were expected. Speaking from personal experience, he shared that he contributes $300 weekly to cover shortfalls on one of his rental properties that's locked into a 6.65% mortgage rate. He emphasised that property investing isn't a quick win. It requires consistent effort, improvements to create and increase the rental yield, and long-term commitment. According to Ball, around 85% of investors also have another job, and the ability to borrow large sums is what sets property apart from other investments. Serena Gibbon, General Manager of the Auckland Property Investors Association, said that many investors operate across multiple entities, which can also distort the numbers. She argued that since the phased removal of interest deductibility in financial year end 2022, inland revenues reporting has not reflected the true economics of property investing. In financial year end 2024, landlords could only deduct 50% of their interest expenses, creating paper profits that don't actually reflect financial performance. Gibbon described the tax policy as being politically driven, but noted that it inadvertently encouraged investors to upgrade their properties, leading to improved housing quality, albeit with rising rents. Based on what I know, it's interesting to note that over the past few property cycles, we've seen the strongest capital growth and the highest increases in market rents under Labor governments and Labor coalition governments, despite all their talk about making housing more affordable for first-time buyers and tenants. That's food for thought, right? Now that full interest deductibility is being restored and mortgage rates have dropped, Gibbon expects more dynamic, yield-focused investment strategies to emerge, which, to be fair, is how it should be, not tax policies that push new investors towards just one sector of the property market, which created so many financial nightmares for so many people that were just hoping to build a retirement nest egg. My thoughts on this is that you should never invest purely for capital growth, as you've got absolutely no control over it. You should also never invest purely for tax benefits. Again, you've got no control over it, other than who you might choose to vote for, and tax rules can change. New builds are not right for everyone. In fact, in our experience, they're right for a very small number of investors. Cash flow is king when it comes to property investing. It's all about balance and knowing your numbers. First-time buyers are snapping up more than a quarter of all properties sold, with some regions seeing even higher numbers, followed closely by property investors. Why? House prices are still below their peak, lending rules are more flexible, and we're seeing more and more buyers who are seizing the opportunity to get on the ladder. However, there is a right way and a wrong way to invest in property. Join us at one of our free events called How to Succeed with Property Investing. These events are all available online, so you can gain valuable insights and strategies tailored to today's market conditions, regardless of where you live. Whether you're an experienced investor or just getting started, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving your financial goals. In our free events, I'll also tell you more about how we can help you as a client to achieve your investing goals. So if you're interested in finding out more about how we can help you, visit propertyapprentice.co.nz today and register for one of our upcoming events. If you've already been to one and you'd like to know more about how we can help you on your individual journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.